The long-awaited federal budget delivered record levels of fiscal support and record levels of debt. Our thoughts on the short and medium-term impact on the economy and the outlook for jobs and property. The 2021 budget deficit announced was just over $213 billion, or 11% of annual GDP, which, combined with further stimulus measures outlined in the budget, plus state government support, is 1/3 of $1 trillion of direct support to our economy over the next 4 years. It's a remarkable deviation from where we were just 9 months ago, but the fiscal response is proportionate to the economic challenge of the global pandemic and is effectively a rebooting of the economy after its deliberate shutting down. The range of support measures and incentives for businesses, households and jobs in the budget were wide-reaching, including the income tax cuts brought forward, full expensing of investments for businesses, and wage subsidies for apprentices and younger workers. The budget assumes that unemployment will reach 8% by the end of the year, and then only a very slow improvement. But crucially, there is the commitment that budget repair and paying down the debt that funds all of this will not commence until the unemployment rate is safely back below 6%. This is a very sensible link of fiscal policy to the economic path ahead, so that support isn't removed until the economy can cope on its own 2 feet. As it happens, the recent jobs data has been encouraging, with the latest payrolls figures showing an uptick in jobs nationally, only around 3% behind where we were in February, and an improvement in Victoria, although still around 8% behind pre-pandemic levels there. Arguably, these numbers are more timely and insightful than the jobless rate, but given a 6% unemployment rate is the hurdle for budget support, this is the rate that will be most closely monitored. Our Reserve Bank are also keeping a close eye on jobs and are considering another rate cut on Melbourne Cup Day, although it would only take us from 0.25% to 0.1%. More importantly, the RBA have said that they won't increase rates until we are safely on the path to full employment. So monetary policy and fiscal policy are moving hand in hand. Stock markets normally like the idea of further rate cuts, but volatility has been building for stocks ahead of the US presidential election, the dramatic COVID-19 news from America, and uncertainty about US fiscal packages. So in a way, the economic outlook has become slightly more encouraging here thanks to all the fiscal support locally, but for equities and FX markets, offshore developments have added to uncertainty after their V-shaped recovery 6 months ago. And finally, property markets continue to hold up far better than initially feared, and the budget announcements for first home buyers were welcome, along with the support for jobs. Government debt is obviously going to be a lot higher in the medium term, but interest rates are at record lows, and the short-term focus is on rebooting the economy. As long as we can keep reopening borders, that foundation has been laid. And that's the market update from Leveraged.